The Federal Reserve publishes a specific number every single quarter that almost nobody talks about. It is not the inflation rate, it is not the unemployment rate, it is not GDP. It is called the velocity of money. To understand why the economy can print trillions of dollars and still feel stagnant, look at this. A massive supply of cash does very little for the average person if that cash remains effectively motionless. The sheer volume of money in a system is less significant than the speed at which it changes hands. $1 trillion locked in an account is static. $1 trillion moving rapidly, paying wages, buying products, and funding local businesses creates the activity we recognize as a functional economy. To track this movement, economists use this formula. The velocity of money is calculated by dividing total economic output, or GDP, by the total money supply in circulation, known as M2. This measures how many times a single dollar is used to purchase goods and services within a given year. Looking at this chart, the downward trajectory is stark. In 1997, velocity reached its peak, with every dollar in circulation supporting $2.19 of economic output. By early 2026, that number dropped to 1.409, a 36% decline. This widening gap between a rising money supply and falling velocity helps explain why personal financial circumstances often feel restricted, even when headline economic growth remains positive. Federal Reserve economists and academic researchers have isolated 3 structural causes for this decline. The first is a direct result of keeping interest rates near zero for the better part of 2 decades. Nobel Prize-winning economist Paul Krugman calls this a liquidity trap. When interest rates are near zero, the opportunity cost of holding cash vanishes. The natural pressure that pushes money back into the economy disappears, and people hold on to their cash instead of spending or investing it. Harvard's Kenneth Rogoff noted that these conditions turned cash itself into the preferred risk-free asset. When short-term government bonds offer essentially no yield, hoarding liquid cash becomes a rational financial choice. The second cause is wealth concentration. Different income brackets move money at entirely different speeds. Lower-income households spend most earnings on necessities like rent and food. This creates high velocity. But high-wealth households park surplus income in stocks, bonds, and real estate. Here, money stops moving. It sits in financial assets rather than circulating. Federal Reserve data confirms the top 10% have significantly lower velocity than the bottom 50%. Economist Thomas Piketty's research documents this shift. When wealth concentrates heavily at the top, the economy's overall propensity to spend decreases. When interest rates provide no incentive to move cash, and structural wealth concentration funnels capital into static assets, the economy's circulatory system stalls. The third cause is psychological. Velocity reflects confidence. When households and businesses are uncertain about jobs or geopolitical stability, they postpone hiring and delay purchases. Fear can override even the most aggressive monetary stimulus. In April 2020, trillions of dollars in stimulus were injected into the system. But because global uncertainty was at its peak, households hoarded that liquidity. Velocity crashed to its all-time low of 1.126. We can see how stubborn this behavior is by looking at the Bank of Japan in the 1990s. Following the collapse of Japan's asset bubble, the central bank cut interest rates to zero and deployed massive stimulus. But traumatized households refused to spend. They held cash and paid down debt, resulting in 2 decades of stagnant growth. Raw money printing is often powerless to force growth if consumer confidence remains broken and structural incentives to move that money are missing. This brings the data down to a personal level. In February 2026, the U.S. money supply reached a record $22.67 trillion. Yet during that same period, nominal wages grew by 3.6%, while inflation ran at 3.8%, meaning real wages actually fell. This pipeline explains the divergence. When injected, money enters the financial sector first. If velocity is low, it stays trapped, inflating assets before reaching workers. This expanding supply doesn't guarantee a better life. Capital pooling at the top limits money flowing into local wages. In this environment, you have to manage your personal household velocity. High-interest debt removes capital from your control. To gain ground, You must seek out productive assets that move your own money more effectively than the broader economy does. There is a sign of recovery. Velocity climbed back over 1.4 by late 2025. As interest rates rose, the cost of holding cash returned, and money began to move again. This 36% decline is the cumulative result of 17 years of near-zero interest rates, wealth concentration, and repeated global crises. Tracking velocity allows you to cut through misleading headlines. It provides a measure of how effectively capital is circulating through the entire system, providing a real-time signal of economic health that raw GDP totals often hide.